Good afternoon and welcome to the Spring 2025 Linneman Associates Capital Markets webinar presented by Linneman Associates and Real Estate Financial Modeling. This is your host, Bruce Kirsch, founder and CEO of REFM, provider of training and certifications to the business since 2009. We're pleased to have an insightful program for you today, which will be presented by Dr. Peter Linneman, founder of Linneman Associates, which for those of you who do not know is a strategic and investment analysis advisory firm. We're using Zoom and we'll just do some housekeeping now before we get started. On the audio front, all of the participant audio is muted, meaning we cannot hear you, and that's going to remain the case throughout the webinar. If you're attending by computer, take a moment to familiarize or reacquaint yourself with the control panel. We will be showing the slides, but if you'd like to download them, I'm putting them in the chat as a link, and you can click on that link and they will come. And we, as usual, are reserving 15 to 20 minutes at the end of the webinar to answer questions. Feel free to send your questions through as they arise. Make sure that you click the send button in the Q&A panel. If at any point you get disconnected, just reconnect the same way you did initially. And if you're registered, later today, you will receive an email with a link to the recording of the webinar and the slides. And the video will also be posted on the Linneman Associates website later today. Without any further ado, I'd like to introduce the presenter, Dr. Peter Linneman, CEO of Linneman Associates. Peter, over to you. And as much as I would like to say, I feel like every day is like Groundhog Day, it's kind of a different world right now, would you say?
Well, it is and it isn't. So one of the things is I think people need to leave the fright house. You have to remember that this is a very politically charged environment. And there's a lot of parties who have a lot of interest in keeping everything politically charged. And I'm not saying there aren't issues, but I think it's important to kind of step back. And it's one of the advantages I think I've always had is I don't really align with either party, so I don't feel there's a side to take. And there's an enormous advantage in that. But having said that, let's go to the first slide. And Bruce, I may do this presentation a little different. You'll have to work with me a little in that I'm going to we have the full set of slides per normal, but I'm going to linger on some talking point slides more and not necessarily get to all the slides with data. I'm going to talk that data, but I think some things in the context that you say is happening flow easier as I talk through them. I'm sure you'll adapt with me. So the first slide, uncertainty, with at least 3 exclamation points. There's uncertainty because the Trump administration is acting with speed. People say, why are they acting so fast? I think there's 2 reasons. One is that they came in quite prepared. They worry about, will they lose Congress in the elections next year? So while it may seem they have 4 years, they may only have 2 years and get a lot of stuff out there. They also believe that there's a lot of things that need to be changed. And obviously the people who aren't for the change are pointing out every problem with the proposed changes. And it reminds me in some ways of what Alfred Taubman told me, I don't know, almost 40 years ago, as we were doing the real estate center back in the beginning days. And he said, you're going to be an agent of change. And remember, the only thing people hate more than change is the person that makes them change. And there is an element of truth I've found over the last 40 years about his wisdom. So that's one reason. The second reason is any of you who have negotiated with, quote, New York City deal people, and I know some New York City deal people are listening, I'm not trying to impugn you, but there's a different negotiating style. and you scream and you shout and you slam books and you say outrageous things, and you assume everybody does it that way. And it's just the modus operandi. And remember that the president is a New York deal person, probably in the extreme, a New York deal person. So a lot of what you're seeing is New York deal stuff. And I was telling a friend this the other day, and they told me of an instance where they were negotiating with a famous New York deal person. And all the person did was tell them what idiots they were, how stupid they were, how their price was ridiculous that they were offering. It's an embarrassment to even talk to them. And they kind of picked up their books and said, okay, goodbye. And as they were leaving the room, the person came over to them and said, hey, where are you going? We're really close to a deal here. And there is an element of that floating around in all this. Some of it's purposeful, some of it is just posturing, some of it is whatever it is. And I think you have to remind yourself that. So there are a lot of uncertainties. One is, what are the impact of taxes going to be? And remember that tariffs are just a tax. That's all they are, a tax. And if you raise taxes a lot on anything, it will have an adverse effect on the economy. It distorts incentives. It reduces incentives to do things that are productive. And that research is basically true, whether it's an income tax, capital gains tax, state tax, value add tax, sales tax, you name it. Doesn't mean taxes are evil. It just means that less growth is the price you pay for whatever you're trying to do with the tax money. Now, tariffs are a tax we haven't talked about a lot over our history, or my lifetime history. Imports are about 10% of the economy, about $3 trillion on a $30 trillion GDP, roughly. And if you raise the tax a little bit, and so, for example, during the first Trump administration, the average tariff paid on $100 of imported items was about $3, up from $2, where it had been for several years before that. Was that good for the economy? No, but it was a 1% increase on 10% of the economy. So its negative effect was there, but relatively small. The tariff package that the president alluded to initially was about $20 on $100 of imported items. And by the way, if you wonder where the president gets big, beautiful tariff revenues, you put a 20% tax on $3 trillion, you get 600 billion. That's a lot. Now, you would never collect that because people would change what they purchase and where they purchase from. But if people didn't change what they purchased and where they purchased from, the original plan was going from about $3 on 100 of imports to $20 on 100 of imports. That's a 17 percentage point increase on 10% of the economy. If you put a 17 percentage point increase on any 10% of the economy through any tax mechanism, it will have large adverse effects on the economy. And without going into the research behind it, it would appear that if that really were to have occurred, it could knock as much as 1.7% of GDP off. Think about in a normal year, we grow 2.5%. So, you're talking about growth going from 2.5% down to 0.8%. on the impact of the distortionary effects of those tariffs. As you know, the tariff talk has come way down. It's hard to know where it would be. If I had to guess where it's going to come out, it's going to be in the range of $5 per hundred. And remember, it was $3 a hundred during the last 2 years of Trump and all 4 years of Biden. So if it went to 105, all that means is a 2% increase in the tax on 10% of the economy. Is that helpful? No. Will the economy pull through? Yeah, probably knock something like 30 basis points of GDP growth off, but you're still going to grow at around 2.2% in that case. So it's still too soon to know. Clearly, there's been a retrenchment from the $20 on 100. And while I'm at it, though, understand that if the Democrats had won the House, had won the Senate, and had won the White House by the same margins that the Republicans swept, there would be a lot of uncertainty in the economy, not so much on tariffs, but there would be a lot of uncertainty on what will the marginal tax rate get raised to, what does the corporate tax get raised to, what does the effective including depreciation and so forth, how do incentives get reduced, estate taxes, and capital gains taxes. So there would still be a lot of uncertainty about taxes, one way or the other. It probably wouldn't have been concentrated in tariffs, but rather concentrated much more so on the traditional areas. Having said that, the Republicans seem to be coming out with something that will look fairly similar to the current tax situation on everything other than tariffs. And therefore, they may raise a little here, they may reduce a little there. The impacts there will be quite small versus where we're at. And so either way, we were going to get a lot of uncertainty. People talk a lot about Doge. I find it kind of funny in that most of the business people I know would love to have someone of Elon Musk's track record come in for free and offer ways to improve their performance, go through their staff, figure out who might be superfluous, etc. We're in such a politically charged environment that that's impossible for the government. Let's be honest, they're not going to find $1 trillion. They are going to announce at the end of the day they found about 500 billion. They'll probably really find 300 billion, good for them, especially if they can keep it recurring. Remember, the government is nothing more than a giant service company. And what service company have you ever known that never fires anyone except the president? And that's essentially what the government is. A giant service company that never gets rid of anybody but the president. It's an odd business model. Of course, there's waste, there's fraud, there's abuse. Almost every president in my lifetime has tried to address it, mostly with very limited degrees of success. Stay tuned as to whether this has any degree of lasting success. I think their view was act fast before opposition can build. And their view was if we went slowly, like the Grace Commission or, the other various programs over the years, the entrenched interest will just slowly derail it and not much will occur. Whereas if they did a surprise attack, did it fast, yep, they're going to make mistakes. they can always undo the mistakes, but better to get things done. So I think Doge is a good effort. Jury's still out on how good. Of course, they're making mistakes. Remember, all of us make mistakes in what we do every day. Will the Fed cut rates? Someday they will. Why? Because the next question is inflation over? So CPI came out yesterday, and CPI, once again, headline was 2.4% year over year. However, in that CPI is a rent increase paid by renters, like your apartment renters, of an average of 4.3% over the past year. Now, I know the CoStar data, I know the Yardi data, I know from talking to many of you, nobody's got an average of around 4.5%. In fact, I think CoStar had something like 3 markets above 4%. There's no way rents paid by renters really went up by 4.3% in the last year. The real truth is closer to zero, not zero to a decimal point, but closer to zero. Secondly, they have this artificial concept that we've discussed called owner equivalent rent, which is the rent that you pay to yourself as an owner, which none of you have ever paid. You have not paid a dime for it. So if you really ask what's the rent that an owner pays, the answer is zero. And yet, almost 25% of CPI reflects the rent that you pay yourself, which you don't really pay. Very different. The other 75% of what goes into the consumer price index, somebody is paying. Not everybody, but somebody is paying. And they had the rent that you pay to yourself going up at 4.5% over the past year. I don't even know how to react to that because no one's paying it. If you take out owner equivalent rent because it doesn't exist, and you take out a 4.3% increase in rent and put it at around zero, you will find that inflation is 1.3% over the past 12 months. Okay? And so if you take out everything people purchase, including eggs, you take everything they purchase, including eggs, and all you do is take out the rent that renters pay, and you ignore this fictitious concept, it's 1.3%. It's been well below 2% now for over a year. The only reason the inflation rate is measured as high as it is fictitious owner equivalent rent and really badly measured rent paid by renters. If inflation is running 1.5%, there's no reason to have a 4.5% short-term rate. It is way too high. It rewards people to do nothing, and in so doing discourages people from going long, illiquid, and risky. Because if I can get a 300 basis point premium over inflation by doing nothing except staying short and liquid, you're really discouraging long, you're discouraging illiquid, and you're discouraging risk. And of course, real estate is all of those, not just real estate. It's not surprising that there's a lot of money in the system, and a lot of it is still sitting in cash, in short term. It will, because the Fed lowered the interest rate by 100 basis points while inflation fell by 400 to 500 basis points. Short-term rates way too high. I famously said on Willie Walker's show almost a year ago that the Fed would cut 3 times in the remainder of 2024 at a time where no one thought it would occur. all I was doing and looking at fundamentals. I believe the Fed will cut another 100 basis points this year, still, simply because inflation is really low. Also, the tariff situation, the uncertainty around it, will probably cause some companies to pause in the first few months of this year, of this quarter, and they're going to get a couple of weakened readings, not recession readings, but weakened readings, and they'll be inclined to cut rates when they see that. I remind you, the Fed is a terrible predictor of themselves. You could say that's good because they're open to new facts, or bad because they haven't got a clue. But in either case, I think you're going to see big cuts. Remember, if they cut 100 basis points down to 4.5%, that's still 200 basis points real return, which is a big spread. It should be 75 to 100 basis points. So inflation is long over. The supply chains that created it are over. The excessive money flow that the Fed was part of is long over. The money supply is not really growing very fast. And therefore, you're just not going to see inflation. Are prices going to come down? No. They're going to be at this new level, and they're going to go up slowly from this new level. People confuse that the rate of inflation somehow falling means prices are falling. It just means the rate at which prices are increasing reduces. So I think the Fed will cut rates this year. Absolutely believe inflation's over. As they cut the rate, the return on short and safe will go down, and the incentive to go long and risky and illiquid will go up, and that will end the lender strike. And you're already seeing a little thawing, but it's got miles to go. As the lender strike disappears and money flows, you'll see transaction volumes get back to normal. Late this year, they'll approach it in apartments, maybe in warehouses. Still well below normal for office, approach normal for retail. But there's a lot of money out there, and you know that it's not normal how much money is out there because transaction volumes are still notably below. As transaction volumes pick up because of the flow of funds, you'll see cap rates come in. I don't care what happens to the interest rate. I think the long-term rate, by the way, is way too high at 4.4 to 4.5 for the simple reason that if inflation is 1.5% to 2%, it should be in the range of 3.25% to 4%. So I think it's because money is being discouraged out of long and illiquid by the high real rate of return on short and safe. Will there be a recession in 2025? No. I don't think tariffs will actually be introduced to a big enough effect to cause taxes to do it through imports. And I don't think they're going to raise taxes enough through the various other tax mechanisms available, income tax, corporate tax rates, personal income tax, capital gains taxes, et cetera. I don't think they're going to change it enough to adversely affect any growth. We're in the fourth year of a recovery. Recoveries usually last 6 to 8 years. There's no sign of a substantial excess in the economy. And in fact, if you look at housing and you look at automobiles, we have great shortfalls of activity. And normally, on the verge of a recession, when you look back, you'll see auto and you'll see housing was well beyond any kind of sustainable or normal number. And we have the opposite. We have them being below normal. And so I don't see any reason to have a recession in 2025. I think a lot of people are trying to intentionally put you in the fright house. Fright houses are fun. Like think of right before Halloween, and you go in and you get the bejeebers frightened out of you, but you can't stay in a fright house forever. And stop watching the news because it's not really news. Stop listening to hyperbolic podcasts. Just focus on fundamentals. And I think you'll do much better. You'll tune a lot of the crazy stuff out. Will major geopolitical events have major disruptions on the economy this year? I don't see it. If the Ukraine situation couldn't notably disrupt the US, it's hard to see an event that notably would, but I could be wrong. Bruce, go to the next slide, page number 3. Big issue is a lot of the sentiment indexes, and of course the stock market in the short term is a sentiment index more than a value index, showing do people believe in growth? Do they believe that risk is low? The sentiment indexes have shown that the economy, no, they've shown that people's views of the economy and the political situation are gloomy over the last 2 months. The only data sign of real gloom was real GDP in the first quarter. A week ago came out and was minus 0.3. And you say, oh, that's recession. It's begun. And you go, you got to look at the data. And when you look at the data, you see consumption was up quite notably. Investment was up really quite notably. Exports were up. Government spending was slightly down. So you say, well, how did we get a negative GDP? And the answer is because businesses imported in 3 months as much as they'd normally import in 5 or 6 months. And the way GDP is calculated, imports get subtracted off consumption, investment, government spending, and exports. And so the fact that you had this abnormal time shift as people tried to cushion their inventories to deal with tariffs led GDP to fall. But it really wasn't a decline in economic activity. Consumption was up, investment was up, and exports were up. And so it was very misleading, even though it was accurate. Economy is still catching up to the shutdown 5 years later, over 5 years later. We've largely caught up, but we still are a bit below trend. The Fed has rates needlessly slowing about 20% of the economy, particularly autos and housing. Interesting is that while the US in general has record GDP levels, about 20% of states and about 20% of metropolitan areas still have not gotten back to 2019 levels 5 years later. So it's not like every place and everybody has had growth. That said, Texas, Florida, the Carolinas, Georgia, Utah, Arizona, Nevada, they're go growth. Go to the next slide. And one of the things that was sort of on the table with the Biden campaign and the Harris campaign was national rent controls for apartments That's obviously off the table. That's a good thing. You've got a notable pullback in regulatory expansion and in many cases deregulation. Um, uh, and it's interesting. People say, "Yeah, but they're deregulating. They can't regulate as much as they used to." And you kind of go, "Well, that was part of the movie. That was the point." Um, I don't think you get major increases in taxes, maybe other than tariffs. And then I already summarized the tariffs. Go to the page 5, Bruce. The next one, the border has gone from where it was, I'm rounding everything, I'm about to say, about 2 million people seeking asylum a year during Bush, Obama, Trump, and then it got up to 3 to 3.5 million a year during the Biden first 3 years. It got back down to about 2 million by the end of the Biden. Um, Last month was 7,000. So 7,000 times 12 is about 85,000, not millions, but thousands. In the short term, that's probably good. It allows the system to digest. The system was kind of digesting around 2 million a year during Bush, during Obama, during Trump. It had a hard time digesting 3 million efficiently. Of course, there's a lot of pain. By cutting down to almost nothing for 6 months, think about it. If you go down to nothing for 6 months or a year and a half, you burn off a big chunk of that 3 million excess that build up over the first 3 years of the Biden. You digest it. We can't keep it that low forever. We shouldn't keep it that low forever. Um, Immigrants are a good thing for the economy. They're kind of what we all are at one level. Um, Deficits, everybody says, "Oh, I worry about the deficit. I worry about the deficit." Um, First of all, there's a slide you'll see in the deck when you look through, and just factually, the Trump deficits during his first 3 years were lower than the Biden in his last 2 years. And you say, well, why do you only do Biden in his last 2 years? And why don't you do all 4 years of Trump? And the point is, I'm a reasonably fair grader. I don't count against Trump the first year of COVID, and I don't count against Biden the second and third years of COVID, at least in a deficit sense. I give them kind of a grace period, and but then I kind of say, well, they were on the course they were on. I think the deficits are too high. I think the deficits are too high, not because we don't raise enough tax revenue, but because we don't make difficult choices in prioritizing spending. We want it all. There is no real empirical evidence that the interest rate is sensitive to deficits or total outstanding federal debt. And the reason is our debt at the federal level is massively over collateralized. It is not backed by current tax revenues. It is backed by current tax revenues and the full faith and confidence of the US economy. And it's a little like saying you have a loan on a property that's not only backed by recourse to the property, but it's also backed by recourse to your balance sheet. If your balance sheet is worth nothing as you raise your debt on a property, even though you have personal recourse, you would see interest rate going up. And that's what happens in poor countries, Angola, Zimbabwe, etc. The US is extremely rich. We're more like Elon Musk. If Elon Musk had a $10 million loan secured by the property worth 50 million and also secured by full personal recourse, if he raised the debt from 10 million to 20 to 30, there'd be no change in the interest rate because of the collateral of personal recourse. As you got to very high leverage rates on his asset debt, you'd see some movement in the interest rate, not because there isn't plenty of collateral, but you got to do brain damage to access that collateral. You may have to sue him to get him to give his personal recourse really there. And that's kind of the US economy. We have true debt, net of what the government owes itself, of about 21 trillion. We have GDP income, if you think about it crudely, of about 30 trillion. How many of you have 30 income for every 20 debt you have? The answer is very few of you. We have 30 income for every 20 debt we have. In addition, household wealth in the United States is in excess of 160 trillion. So our wealth is about 8 times our current debt. And by the way, 2/3 of that debt is held by US citizens. So even if we paid it off, it would be an income for US citizens that offset the outflow. And so we have massive, and then if you think about all the businesses that are yet to be formed, all the income that's yet to be generated by the future of the economy, massively over collateralized. So do I worry about the deficit? No, it's a big political problem because as you try to access that recourse beyond current tax revenue, it's like trying to access the recourse beyond the property. It's a pain, it's a tedious process, it's a highly politicized process. And but the real problem is we're not getting our money's worth for a lot of what we're spending. It's not the deficit, it's wasteful spending. And wasteful is wasteful whether we have a surplus or a deficit. Fortunately, we can afford to be wasteful. And then, Bruce, I'm going to just come in for a landing here on a couple of quick charts. If you go to slide 6, S&P 500, among all the screaming and shouting and the market's down and the this and the that, even before the increase, one of the things I do is leave the fright house. And I always look at when was the last time the market was at the same level it is today. And I've been tracking this since all this noise about the drop and so forth. Well, what you can see is where we're at today is basically where we were in March on the way down and where we were in September 24 on the way up. And I think most of you were reasonably happy with where you were in September 24, sort of 9 months ago. I think all of you would have been realistic enough to know that there is no guarantee the market would be up 9 months later. Of course, you'd be happy if it was. And it's not risk slitting kind of terrible. It is a fact. So I would urge you to get used to looking at when's the last time the stock market was where it's at. And even when it got to its bottom, the recent bottom, you were still talking about it was where it was April last year. So it was basically 10, 11 months of no net gain. Yes, it went up and went down. We're a little bit like a spoiled football fan. We believe we deserve to recover all fumbles our team fumbles. And we also deserve to recover all the fumbles the other team makes. We don't deserve either, right? And there's an element of just understand the facts. If I were to say anything to wrap up, the real estate is still got solid demand. The economy is still growing. We have solid demand. The weakness in apartments, the weakness in warehouse came not from weakness in demand, but a spurt of supply. And demand is held pretty strong. It's just spread among this spurt of new supply. Retail, good retail is doing well. It's a tough business, constantly grinding it out to deal with consumer tastes that change, but it's doing quite well. And hotels are doing solid. They're being hit by increases in operating costs. Their revenues are still not fully recovered in real terms, but they've come a long way. They still have more distance to go. Just one note, senior housing is about 2 years away from the long-awaited, the baby boom is aging. The front edge of the baby boom is now 78 years. Most people these days don't really consider senior housing in mass until 80 or more, but that boom is actually close to getting there and will go a long way to impacting that sector. The last thing I'd say is the consumer. The consumer is in, as a general matter, is in quite good shape. Their wealth is up. Their home values are up. They have jobs. We're still adding jobs at a reasonably healthy rate. They're about 40% of consumers locked in super low interest rates on their home, which leaves them more spending power than historically they would have. So they're in good shape that way. Yes, things like delinquency are up, as is the ratio of debt service on personal income, but they're up from extraordinarily low levels. They're still well below normal historic levels. Are there people over leveraged? Of course, but there are always some people like that. Last thing I would say is oil is holding down. That's a tricky phenomena for the US because we're a net oil producer. So net, we lose a bit when the price of oil goes down. However, many American consumers win when the price of oil goes down. So even though net we lose, there's probably more people who win when the price of oil goes down than lose. It's just that those who win a lot and more than offset. So, Bruce, I would end by saying, leave the fright house. Stop watching this crazy stuff. Stop listening to this crazy stuff. It's not crazy because it's Republican. It's not crazy because it's Democrat. It doesn't affect your business as much as you think. Stay focused on managing your properties, managing them well, having good properties, and generating cash flow. Avoid the fright house. So with that, Bruce, I'll stop and give people about 15 minutes. And the thing I'd say is the slides that are available basically show in chart form the things I covered, but I think given the way a lot of these interact at this moment, I thought that this would be a more helpful approach, Bruce.
Great. Thank you very much, Peter. So we've had multiple folks write in about the wackiness of this owner equivalent rent structure that's in the CPI and in the CPE, and why is it there in the first place, and how come it hasn't been removed? And
Okay, so first of all, Europe, for example, in their data on inflation does not include it. They focus on things that people purchase. If you go back 50 some years, the price of a home was included in the consumer price index, but it generated a very odd result. Namely, as the price of a home went up, it appeared that the cost of living went up, when in fact, 2/3 of the household were better off because 2/3 of the household owned a home. Okay. And they realized that in the same sense, they don't have gold in the index, they don't have stocks in the index, they don't have bonds in the index. It's a consumer price. And what they should focus on is not asset prices, and whether you're a buyer or seller of those assets, make it a pure, what do people buy? And they tried to pick up the fact that some people are buying a home in real time, but they didn't want to simply say, well, we're going to track home prices the same way we track gold or silver or stocks or bond prices. And they made the mistake of coming up with this crazy concept. And you can argue it's an intellectually kind of interesting concept of, gee, what, I mean, I actually did a research paper 45 years ago or so. And what I was interested in is what effectively is the cap rate that owners apply to their home. Okay. And why was I interested in that? I was interested in that to address the question of, is there an arbitrage between the cap rate that landlords demand versus the cap rate that owners demand on their own home? That is, how big was an arbitrage opportunity there? That was actually an interesting question. And you can imagine it as a precursor to the notion of single family rental as a business. What's the cap rate I can get and what's the arbitrage between? There's a long gap between that intellectual exercise and including it in a consumer price index as if people are purchasing it, and they're not. And it's just a mistake. I'm going to call it as blunt as that. It's a mistake. It is not a mistake to keep an eye on what home prices are, or what gold prices are, or what stock prices are, because not everything not everything people do is reflected in consumer prices. There are asset prices. But tracking asset prices become very tricky to infer what to do. And in fact, I wrote extensively during the previous decade that one of the things that happened was we flooded the system with a lot of money, and most of it stayed in the system. And that which came out did not go to consumer goods, it went to assets. And that's an interesting insight, that asset prices rose notably, but consumer prices didn't. And I think The truth is, we're in a world where consumer prices are not going to rise very rapidly, but asset prices will, moving forward. So they just made an intellectual mistake. I don't know how else to say it.
Okay, great. Thank you. In your discussions with business leaders, have you sensed that there is an appetite right now for hiring in commercial real estate and maybe even outside of commercial real estate now that we have this temporary stay in the what was going to be a massive tariff with China?
Well, I think it's fair to say that the data is still showing a pretty strong labor market. Weekly new unemployment insurance claims have stayed quite solid. Just came out, it comes out every Thursday. Just came out this morning and shows very strong level of weekly unemployment insurance claims continues, which is a sign of a pretty solid labor market. The employment data from last month was quite solid, quite good, actually. So employers seem to be still hiring. They aren't hiring at an abnormally high level. So getting a job is back to where it was, namely, it's hard. It really is hard. If you come into the real estate investment sphere, I think it's harder than normal. Why? Because raising capital over the last 2 or 3 years has been harder than normal. And to invest, you need access to capital. And as the amount of capital that got allocated was reduced, and we know that by just looking at transaction volumes, not to mention what Preqin and others show that funds have raised and so forth. If you see abnormally low levels of transaction volume, it says that capital has been short. And therefore, I may still have a million dollars, excuse me, a billion dollar fund. I may still have $1 billion fund, but my last fund was $1.5 billion. And I don't need as many people for $1 billion fund as I needed for $1.5 billion. Even though I'm still a big fund, I'm still a big beast. The growth ceased. And by the way, even if I'm still $1.5 billion fund, I don't need a lot of new people. I've already got them. When I need new people is when I went from $1 billion to $1.5 billion or $1.5 billion to $2 billion. So I think it's harder than in most places for real estate, I think in PE in general, because money is not flowing. And as a result, transaction volumes are down. I think on the asset management side, the positions are there, the assets have to be managed by somebody either way. But the acquisition and diligence kind of positions are down.
I was just reminded of, I heard an interview with somebody at one of the big platforms. Somebody had asked them what their biggest fear was, and they responded, their biggest fear was what the headline is going to be tomorrow morning. And we've sort of been living that here, and it's hard to believe that it's only been 100+ days.
The way to stop that is stop watching the headlines and focus on fundamentals.
Yeah. That said, what concerns you?
Well, people always ask that, and people never like the answer I give. I'm very concerned, and I have been for years, about the erosion of our education system, because what fills our buildings is growth, innovation, creativity, and the erosion of our school system, education system, K through 12, university, and graduate levels has eroded. Does that mean every part of it has eroded? Of course not. There are some that are more spectacular than ever, but as a general statement, it's eroded. And I saw I think it was the Department of Labor study put out a week or two ago that pointed out, and I'm doing these from memory, Bruce, but the spirit is right, that the unemployment rate among people in their 20s, so these are people who have said they either have a job or are looking for a job. We're not talking about people in school. People in their 20s, the unemployment rate for those with a 1 or 2 year post high school degree is about 2%. The unemployment rate among people in their 20s with a 4-year, so-called 4-year degree, probably took them 5 or 6, but a so-called 4-year degree, was some number like 18.5%. And then among those with graduate degrees, it was something like 8.5%. Well, that's a horrible indictment on the value add that universities have added and graduate programs have added if their unemployment rates are multiples higher than those who didn't go on to further education. Now, does that mean everybody has been harmed? Of course not. But I really do worry about the education system, and I worry about it at every level, even though some parts of it are the greatest that has ever existed. And I don't say this in light of the Trump attacks on universities and so forth. Any of you who have known me know that this has been a very real concern of mine for 20 years or so. So that's what really worries me. And the funny thing is, Bruce, that's not sexy. What's sexier is to say, well, will the Fed cut the interest rate next month by 25 bips? For the performance of your real estate over the next 10 years, the success of our education system has a lot more to do with the success of your property than whether the Fed cut the interest rates by 25 bips next month has on the next 10 years of your real estate performance.
So keying off of that, what's your thought on AI? Obviously, there's just an incredible amount of hype, but in your mind, is AI a net positive for education? Negative?
I think it's too soon to tell. It will certainly have some positive effects, and it will certainly have some negative effects. And one of the things we've seen from all technological advances, I think, over history, are some amazingly good things came out of it and some amazingly bad things came out of it. And just think of the internet. So some amazingly good things came. I'm reading Jonathan Haidt's book on teen usage of social media. Some amazingly bad things have happened. You unfortunately can't pick and choose. And I think that's generally true of technology, is that as it begins, we think of all the amazing, wonderful things it can do. And then what we realize is, yep, it can do some of those, but it also does some amazingly bad things that we never thought about. Because I don't think by and large people were trying to come up with these things for bad purposes, but we have an amazing ability to turn good to bad. So I think it'll net be good. I think it's too soon to really say. I was asked that question in a session with Willie Walker the other day, off tape when we were live with YPO. And I said, look, you don't ask a 74-year-old to opine on how a new cutting edge technology is going to affect an industry over the next 10 years, because all I do is call a 16-year-old and ask. And I figured got myself off the hook. And then I said, but Willie, you're the right age, you're involved. And Willie gave a great answer, saying some great things are happening, but it has risk. And then he pointed out how Harvard Business School, he was at an advisory board session. He's on their advisory board, and they told them all the great ways they're using AI at Harvard Business School. And they're doing this at the Harvard Business School with AI, and they're doing this with AI at the Harvard Business School. And then Willie ended. And I said, well, Willie, Harvard needs AI a lot more than Wharton because they don't have as much natural intelligence. So maybe that's a good line to end on, Bruce,
Okay.
as a Wharton grad.
Well, thank you, Peter. Unfortunately, we're not going to be able to get to all the questions that came in. I want to make sure everyone knows this presentation is just a digest of what's available in a lot greater detail in the Linneman letter, which is a quarterly subscription from Linneman Associates. And you can find more information on that at the Linneman Associates website, linnemansociates.com. As a final reminder, if you registered, you will automatically receive an email link to the recording of the webinar in about an hour. And we thank everyone for joining, and we wish you a safe beginning of summer, and we look forward to seeing you back next quarter. Thank you, Peter.